Performing at its best, an unique combination of sea, road and rail logistics, Transport Corporation of India. A logistics company with a difference, creating significant value with joint ventures. A modest mid-cap company in logistics, consistent delivery in both top line and bottom line. A very supportive price earning multiple. Its business segments are its strength. Three broad business segments comprehensively covering logistics. Considerable depth in every segment. Modest freight profits, impressive contribution from supply chain services, and overwhelming profits from SEAWAYS segment. The three segments complement each other to make a composite margin map. A high revenue and a lower profit profile, the essential feature of a highly competitive freight segment. A revenue volume matching the freight segment but with a rich and rewarding margin percentage. Relatively small in volumes of revenue but contributes about 60% of TCI's profits. Exceptional profitability, head and shoulders above the other two segments. Each segment is a unique story. Asset light, highly commoditized and severely competitive, serving small and medium enterprises. Margins are impacted by the truckload composition. LTL has been quite hurtful. A specialized coverage of auto logistics, cold chain and warehousing, serving industry volume leaders. Matching infrastructure with the sector requirements of largely auto, pharma and retail. Owns and operates commercial ships and shipping containers. Presence across major ports of peninsular India. Capex intensity but strong and attractive margins. Fleet expansion quite regular with orders currently placed for new ships. The operating synergy of the three segments is the secret of TCI's success, but SEAWAYS is quite unique in its achievements. A constant rise in the share of EBIT over years, moving gradually from 45 to 60%, a segment that solely determines the growth momentum of Transport Corporation of India. Healthy operational efficiencies and exemplary cash generation over years, a strong sustainable growth rate, has been managing capital expenditure almost entirely through internal accruals. A balance sheet that radiates exceptional health indices quite evident in the two latest years. Just nominally incremental non-current liabilities. Huge growth in equity observed during the period. Equity funding the gross assets to an extent of 75% over years is just amazing. A sizable holding indicates firm commitment from the promoters. Confidence is quite evident from mutual funds in their incremental holdings. Aggregate institutional holding almost on par with the holding by the public is quite indicative of strong market support to the company. Anticipation of positivity evident in the price candles. Price earning multiple turning more attractive, quite cheaper than that of category peers. Book value multiple is at its lowest best. A scenario evidencing a probability of a value proposition at hand. But TCI has certain inherent growth concerns. EBITDA percentage has stayed almost static with near minimal growth rates, exposing the wafer thin margin of safety to the risk of higher vulnerability. However, variation in other income, interest and depreciation have impacted the net profits of TCI. Quite interesting to note a significant fall in the revenue growth rate with a minimal fall in the margins. But quite concerning is the aggressive fall in the profits growth rate, largely contributed by variations in other income, depreciation, interest, and taxes. Also worth noting are its return ratios. Weakness in return on equity and return on assets quite evident in FY26. The fall in the return on assets suggesting a substantial increase in gross assets probably not represented by corresponding profits, a reflection on the effectiveness of asset utilization. But TCI as an investment idea has more reasons to bet on: a growing revenue, improving margin, and a strong cash generation, success of the integrated approach, paying rich dividends, preparing for opportunities in the growing infrastructure sector, a better placed price earning multiple as compared to sectoral peers, flexibility and cost benefits from the blowback. Growing sectoral competition is pressurizing the margins, cyclical nature of the industry, and the cost impact of geopolitical developments, asset heavy infrastructure, and the resulting uncertainty in the implementation of capex programs and its impact on financial results, over dependence on SEAWAYS segment, the huge risk of any sharp drop in shipping rates turning quite catastrophic. The presentation is a part of fortnightly delivery. You can access quality videos at our info card. Your views and valuable suggestions make a difference. A big thank you for your valuable time and kind interest. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever required, may please seek the advice of a competent professional before taking action of any kind.